Welcome everyone to our weekly sort of week ahead view. Take a look at the sort of markets and some of the pieces that we've put out recently. I'm joined today with Antonio, Macro Hive sort of US strategist, particularly in rates and all things economics as well. So I guess so. Thanks very much for joining us, Antonio. Again, you've been a great sort of staple on the weekly video. I suppose it's been quite an interesting week, particularly markets. A lot of stuff's gone on, particularly in the US, and we've got an interesting week ahead. Could you start by just running us through some of the things that have happened in the last week?
Yeah, sure. Hi, everyone. So I think this week, that is Friday, so we are still in the current week. I think it was, quite interesting in the sense that the data, I think, more or less confirmed that the economy is still growing above potential, and inflation remains sticky above the Fed target. That's the main message from the data. GDP actually was growing in Q1 at 1.6 annualized rate, which was below expectation. But when you take a measure of core GDP, which is final sales to domestic purchasers, which removes volatile items, then the growth was still quite strong, because in Q1 it rose about 2.8%, if I'm not wrong. So resilient growth above potential and sticky inflation. Today we got a core PCE, and even if the scenario in which core PCE, given the data yesterday, could have been 0.5, did not materialize, and actually it was 0.32, so in line with consensus, so an high 0.3. Still, it basically gave a similar message to the CPI, even if at a lower level, because as we know, there is a difference between CPI and PCE. And the main one is that the weight of housing in PCE is much lower than the weight in CPI, plus some other differences. But the main message was that housing inflation remains sticky at a too high level for the Fed, and core services, excluding housing, has been recently accelerating. So I would say that that's the main message from the data this week. So there is no surprise that recently rates have gone higher on the base of that, and also probably also on the expectation that the next round of issuance could see another large coupon issuance from the US Treasury. So we will see, but that's basically the main message from last week, I would say, from this week actually.
Not just for Antonio. You mentioned sort of the issuance side. We've got the QRA coming up next week, so the week coming up now. Could you run us through some of the things that the market's going to be looking at within that, and if you've got any sort of expectations around what we might see there?
Yeah, so I think the main interesting thing will be, so there is the financing needs, the first thing that we will look at. Then there is the target for the TGA that will be updated, and then there is the net coupon issuance for the next quarter. So as a reminder, last QRA, we got the net coupon issuance for the next quarter. It was the second quarter at the time, was about 540 billion. So we need to see this time the net coupon issuance for Q3, which I would expect still a number similar to the previous number I mentioned, so still elevated. And I would expect also on the TGA that the target will not materially change below the current target. Could be a little bit below, but not materially below the current target. So that would mean that still we will see significant coupon issuance, which, as we know, can be more problematic to absorb for the market with respect to bills issuance. Clearly, there is some politics around QRA and the decision. So to me, if the decision is based on economic rationale, to me would suggest this type of scenario that I just described. But obviously, it could happen that instead the decision will be to issue less coupon bond, and so to issue more towards bill. Let's remind everyone that at the moment the issuance of bills is still more elevated than the historical average in period of no recession like it is now. So, but it could happen that the Treasury, so Yellen, decides a more dovish type of issuance, and will reduce the coupon issue. It's not my expectation, but it can happen. So if instead I think the coupon issue remains elevated as I think, over time it could, in a context of resilient growth and sticky inflation, I think it could push the term premium higher, even with respect to the current level. So I wouldn't be surprised to see another 15, 20 basis point of term premium going higher over time, in case in which, again, the economy remain resilient, and then I think it is absolutely possible, which translated into long end of the Treasury curve, I think we could still see bond yield drifting higher and probably arriving to the levels that have been reached at the previous peak last year at the end of October, if I remember correctly. I think is absolutely possible.
Yeah.
Last point is that instead, if I'm wrong and there is a more issuance skewed more towards bills with respect to what I expect, then we could see a rally in Treasury yield, which I think, in my opinion, would be to fade, provided that growth remain resilient.
Yeah. No, so just to summarize, expectation is for the bill issuance to be, or net bill issuance to continue to be wound down back towards more normal levels, but there's always a risk of, she does lean on that on the sort of more political side, I suppose. Quick question, what do you, I mean, I know we've been sort of speaking with clients all this week around this kind of stuff, and there's been some quite mixed sort of thoughts on that front. Do you think expectations around QRA are particularly sort of strong right now, or do you think that so obviously it has driven pretty strong market reactions like back at the end of last year, and but then at other times very little reaction, kind of depending, it seems, what the market's focused on. Do you feel like the market's more focused on it right now than it was, for example, for the sort of Q2?
Yes, you are right. So I think there are many people that they are extremely good in forecasting this type of number because they have been doing for 20 years. I think I'm not sure because many of them I don't receive their forecast actually, but I think probably my expectation is in line with the consensus, to be honest. And I think I don't expect necessarily an immediate strong market reaction unless we get even more coupon issuance that I expect, then I think the market would react. But it's conceivable that we don't get an immediate reaction. But to me, over time, as I said, the reason I used over time, because I think still would be significant issuance and then will push yields higher, because I still think the economy is resilient. Obviously, if we get some very weak data, some very weak non-farm payroll and so on, this will dominate, I think, the price action, at least in the short term. So I think that that's where the consensus is. I know that there are people also thinking that there could be a very good chance of a very dovish QRA, in which she will really materially reduce the coupon issuance. I think it's possible, honestly. So I think we will more probably react post number with updating our view rather than trying to be too sure on the forecast, because I think is rather difficult in this case.
Oh, sure thing. No, that's a very good point, in fairness. There's quite a lot going on, so definitely in the near term. Which brings us quite neatly to, I suppose, the Fed next week. What are sort of your thoughts around that? Obviously, things have moved much more hawkish recently in terms of the data. We've had some strong numbers this week. What are the main kind of takeaways do you think that are going to come out of that meeting?
Yeah, so first of all, given the data, already Fed speak before the blackout period have highlighted that the bumpy road story is less sure, because it's already 3 months in a row of elevated inflation. It's still possible that we got a few months very low inflation at the end of last year. Now we got a few months of more elevated inflation. So it doesn't mean necessarily that we get another 3 months like that. So I understand if they keep still faith on the fact that the Fed will not have to hike, on the fact that monetary policy is restrictive, on the fact that and I think they will keep in the statement the phrase that the committee does not expect it will be appropriate to reduce the target range until they gain greater confidence that inflation is moving towards 2%. And I expect them and Powell to say that the recent data has not given them this greater confidence, so they are prepared to take the Fed fund, to keep the Fed fund where it is for longer. But I think at the same time, there are some hawkish risk, I believe. The first one is that I think Powell during the Q&A will be pressed to answer questions like, are you sure that monetary policy is restrictive? Do you really think that hikes are not on the table in case in which we have another strong inflation print and so on? And I think in that case, he will reply that if the data requires it, the Fed will not hesitate to hike rate to restore price stability, which as said in the past, but I think this will prompt a little bit more concern about the fact that maybe monetary policy is not that restrictive. And second, more concern that to bring down inflation, you will probably need to induce some more material slowdown in the economy. So it's going to bring the other side of the mandate into play because so far, in particular towards the end of last year, when Waller first and then Powell, they clearly pivoted and they were more sure about the fact that really the soft landing was on the cards because inflation was dropping, rates were dropping, and the labor market was very resilient. At this point, I think the probability of that soft landing, that in my view has always been very low, it remains very low because it shows that I think the Fed will struggle to bring down inflation close to target without inducing a material slowdown that could be a severe recession, could be a more benign recession. That is difficult to know, but I really think they will struggle to do that. So there are, I think, a little bit of hawkish risk on during the Q&A. I don't expect in the statement a change in the forward guidance, but in the Q&A, I think the market could interpret a few answers like Powell being less sure that monetary policy is restrictive. So if I have to bet, I think it will be a meeting with an hawkish tilt. I don't expect a massive market repricing out of that because I don't think it's Powell what he wants. Also because there is the June meeting with the set of the summary of economic projection in which my current base case is that we go from 3 to 1 in the median of in 2024 median cut for 2024. But at this point, I think he will try to come out of the meeting without having the market moving too much. But I would bet on a little bit of a hawkish tilt in terms of risk on the looking at this meeting.
No, sure thing. No, thanks very much for that. Yeah, I mean, as sort of always flag to our sort of listeners, please sort of get in touch if you want to hear any more of our views, just to sort of flag. And obviously Antonio has been putting out quite a lot of good or great stuff on all these topics. So yeah, please sort of join us on macrohive.com to sort of read more of it. I suppose we can happy to sort of switch to the European UK side. So
yes, okay. And then at the end we do maybe a couple of minutes on the data on in the next week.
Oh yes, of course.
In US, yeah, but we do at the end.
Awesome.
So I wanted to ask you, Henry. First, I think you are coming back from holiday first, so you had a very good time because it's good to stay some day without looking at all this data and so on. But if you look at the last week or so, is there anything you want to highlight in terms of UK and Eurozone economics that you think is relevant?
Yeah, sure thing. I mean, I suppose the the big things in terms of what we saw last week was, so the last 2 weeks, I suppose, is the most important thing because when I was off and then this week that's just been, the main sort of takeaways was on the UK side. The interesting things to see was the kind of divergence or the apparent sort of split between Bank of England internal speaker or internal voters' comments. So we had Ramsden, sort of deputy governor, coming out very, very dovish, or well, much more dovish than a lot of people I think had been expecting, which is very much in line with our sort of dovish views on a lot of points around sort of how strong inflation has been in sort of the core services, and also in terms of things like inflation expectations coming back down to quite normal levels and the labour market looking quite loose. And then just a few days later, we had Pill, so he's the chief economist of the Bank of England, coming out and saying that things are very basically unchanged from when he'd looked at it in March, so at the start of March when he did a speech in Cardiff. I think the market reacted pretty strongly, so it was pretty much sort of a bit of a back and forth whiplash over a couple of days in terms of being quite dovish, and then suddenly also more cuts priced in, and then suddenly pairing that quite significantly with Pill's speech. My take would be, to be honest, that the main conclusion should be that the internal one member from the internal sort of voters has shifted more dovish, and another has not been super changed by the fact that we had mixed inflation labour market data last week. So we had inflation came out a little bit stronger, but some of that, or a lot of that, was in sort of sectors that are not really that concerning for the Bank of England, so things like communications and stuff. And then we had a much weaker sort of labour force, labour market data, in terms of certainly the labour force survey numbers, which, although they're a little bit not the most accurate numbers, it seems, it was kind of backed up by also sort of HMRC PAYE data, which suggests basically that employment as a whole is starting to drop now. So in terms of what Peel actually said in March, it was that there's some way, also cuts are some way off from his March baseline, so his March sort of time frame. Our base case has been for June cuts. I think June cut, it's not, I don't think that it's contradicted by it being some way off from March. And every reference in his most recent speech was that it was still some way off from March. So it's a bit of a sort of strange way to put it. But the sort of main takeaway should be that he sees things needing to stay restrictive, but that a cut doesn't mean it won't be restrictive, which really adds to my kind of view that they can actually, when they do come to cut, which I think, as I say, sort of June is base case for me, they'll do it hawkishly. They'll try and ensure that the market doesn't run away with it, and really sort of start pricing more in, particularly in the sort of 3 to 5 year space, and swaps, because that's where it really feeds into the mortgage market and the economy more broadly. And then otherwise we had PMIs. To be honest, I mean, the way I like to sort of look at the PMIs is very much on the details, so things like what the expectations around employment are, and input prices and prices out. But on the whole, I mean, they've not been so useful since the COVID. They've kind of diverged, been a lot more volatile than a lot of other surveys, and certainly than the actual data. And there's been a lot of seasonality in the headline numbers, particularly in Europe. So we've had sort of these positivity in Q1, or sort of H1, then that fades away into H2. So I think a lot of people, there was quite a strong market reaction around at times, but it felt like there wasn't much else for them to go on, and that might be why it is, rather than anything more sort of substantial. Much more sort of, yeah. So that's kind of been my takeaway from the last couple of weeks at this stage.
Let me ask you a question, because I think it would be quite interesting for our audience. The labor market in UK, also because at Macro Hive we have been doing a lot of studies on the UK labor market, and yeah, you are the best person to talk about that, I think. So maybe shortly for our audience, what happened in the labor market, because it was not easy to read the labor market, and where we are now in the labor market in UK. So why it had, was difficult to read the numbers, what happened, and your view now.
So, I mean, there's, I guess, two ways of looking at it. One is the wage side, and then one is the total unemployment and employment. So if we look at the unemployment rate, part of that is driven by sort of rising unemployment over time, which is kind of dovish. I suppose. And then part of it is being sort of suppressed by the fact that participation rate in the labour force survey has come down quite a bit. So it did kind of drop down, then came back up again, but then it's come back down again, which just means that if fewer people are participating in the labour market, then they don't count as unemployed. So your unemployment rate actually falls, and it suggests that the labour force is a bit tighter. Labour market is tighter because they're basically they're not looking for jobs. So when companies are posting vacancies, for instance, they're competing for fewer employees, so have to presumably pay higher, etc. The issue is that the unemployment and labour force survey data, more generally, suffered quite badly through the second half last year on falling response rates. So the survey sample size dropped quite a lot. The unemployment rate ticked up lots. And then they basically did this big remediation exercise where they tried to sort of fix some of them. And unemployment dropped back down quite a lot on the back of that, the rate, and now it started to tick back up. But there were some methodology changes in October and January. So being able to, long story short, discern what's methodology effects and what is actual loosening in the labour market just from the labour force survey data is quite difficult. So I would kind of, to be honest, only really take much of that with alongside other things like the PAYE data, which is sort of the HMRC's log of how many people are paying tax. So it's a pretty accurate, full sample of sort of full number of people paying sort of employees, basically. So that's why it's a little bit more. I mean, overall, it feels like there's across the survey. So in terms of companies looking for labor, people sort of fears around unemployment, the sort of PAYE data that the labor market is cooling quite a lot. And the number of vacancies is also kind of coming down a bit. So over time, so that's also suggests that sort of firms aren't quite sort of looking for as much employment or sort of as much labor. So that kind of all is more on the sort of dovish side of things cooling down a bit. On the wage side, trend has been, at least through the start of the year, for the wage to be sort of declining. We did get a bit of a surprise, or upward surprise, at the last print, but there's a few things that kind of need to be borne in mind, which is which sectors are kind of seeing the wage rise in particular. So while services inflated, so one of the reasons why we were quite dovish at the sort of middle of last year was whilst there were these sort of rising wage costs, wage growth in services, it was quite concentrated in what you'd call like business to business services. So things like professional services, finance, which don't really or shouldn't really have much of an impact on the cost side of firms. So, for example, if you're buying a Costa or a coffee or something, it's not the guy behind the counter's wage that's pushing it up. It's the sort of banker down the street. But that's kind of shifted a bit into the end of last year. So it shifted away from those kind of sort of business to business sectors and more towards business to sort of consumer. So things like retail, wholesales, and sort of catering and accommodation. And that's a bit of a concern because the more wage intensive services sectors, where basically wages are a larger proportion of their costs, that's really where the Bank of England's quite sort of watching closely. So there is a risk that kind of sort of tailwind, I guess, of higher wage costs into the end of last year in those sectors could cause price rises through sort of the start of this year. Yeah. We're not seeing that so much so far, but it's kind of a risk and something we're kind of bearing in mind right now. So that's kind of the current situation on the labour market side. I think on the whole, the Bank of England will probably look through ultimately the wage, sort of whatever the wages and whatever unemployment's doing, so long as inflation continues to come down. I think that's the kind of key. So it becomes more concerning for them when they don't really understand why services are staying sticky, for instance. But when they're coming down, the sort of momentum in services inflation, it's less of an issue because it's not in their mandate. It's the inflation side that really is. So that's why I think, based on sort of the current trajectory, inflation is going to be sort of probably revised down in the next sort of inflation target, or sort of inflation forecasts, and there's going to be a bit more dovishness, so a bit more kind of comfort with regards to easing in the near term based on that. So that's kind of how I've been sort of reading it so far.
Yeah. So maybe another question would be, clearly we are advocating a little bit of a divergence from the US and Eurozone and UK. And you already answered partially because of your last statement about inflation. So what is the main risk that you see that could happen such that we don't get that divergence
Yeah.
that we think should happen?
So I think it's a very good question, and markets have been very sort of correlated since at least also October last year in terms of pricing for the amount of cuts to come across the Bank of England, Fed, ECB, and other central banks as well. The I suppose my main kind of feeling at this stage, especially for the ECB, is that ultimately when it comes to policy transmission, they're going to want to, if they're getting less loosening of financial conditions, sorry, from US being more from Fed being more dovish. So if US rates are higher, that is going to transmit into European rates and keep financial conditions more tight. So if they feel the need to loosen and the market is moving against them, that means they have to loosen more, if anything. So that's something that's not really been priced into the market so far. And even while we've kind of been a little bit more hawkish than the market on ECB, that's been something that's I think is going to become more important as we get ahead. I'll speak a little bit more about inflation, European inflation that we get next week in a second. So the real risk, I think, is not so much that and this is the same for the Bank of England as well, is not so much that the Fed stays hawkish and therefore even maybe even hikes, say, in an extreme example, and that they have to sort of match that by sort of prevent the currency sort of moving too much and importing inflation. The risk that they're probably more concerned with is those structural elements that have kept US inflation, service inflation sticky. Is that going to crop up in their countries as well? So US inflation has kind of, I suppose, moved a bit faster than the rest, and then come back up, and they'll be concerned that those sort of effects are coming through, so they don't want to ease too early in case those come through. I think on that front, it's worth noting, and it's very well documented, that the economies are in very different places. The US had massive fiscal policy. Consumers have been winding down savings rates, which is very different to the UK and Europe. So UK, I would say, is probably in the most dovish position just because the consumer's really been driving up its savings rate, policy transmission via sort of rental inflation, and also via mortgage fixing is much stronger than in the US. And the government's basically kind of got its hands tied in terms of how much it can actually spend more, because we've had this sort of recent history of a really bad market reaction to anything kind of dramatic from the sort of Kwarteng Truss sort of era, very brief era. So I think fundamentally that kind of risk of sticky inflation is much lower in the UK. For Europe, it's a bit harder to see just because there's probably more room for fiscal spending there to sort of kick off, particularly in Germany, I would say. And also we have had this sort of quite strong Q1 wage-intensive services inflation, which they're going to be sort of bearing in the back of their mind quite strongly. But at the same time, at this stage, I think June, Europe, there's going to be a very high bar for them not to cut the ECB, because they have kind of tied themselves to it. It's probably taken a lot of effort to kind of get everyone on board on that within the sort of governing council. And ultimately, it's almost a bit of a credibility story if they have to sort of wind that back now.
Okay, thank you. And you mentioned European inflation. So what are you looking at for next week?
Yeah, on that front, I suppose the interesting thing is really going to be what the Easter effect was. So we saw service inflation tick up quite a lot in March, just because there was an earlier Easter. But it doesn't really look like looking at the sort of detail, like it had that stronger impact. So I think that's going to be a concern if we were to see services inflation stay quite high in Europe in April in particular. My analysis is very kind of aligns with both market consensus at this stage and also Sam, so our sort of quantitative analysis analyst, Sam, researcher, who sort of puts out an inflation model as well. So they're both the market's looking for 2.7% in core, Sam's got looking at 2.64%, so a little bit lower. My model kind of agrees with that. In the headline, it's sort of, again, relatively in agreement, although I see a little bit of downside risk. So the market's kind of looking for 2.4%. Sam's looking for sort of 2.35, so basically on rounding 2.4%. I see risk of it coming in a little bit lower, so 2.3, 2.2 kind of thing. But ultimately, it's quite an uncertain one just because you've got that Easter effect. So I wouldn't sort of tie my expectations too closely to my forecast, at least. I think if we were to get those kind of results, that would be that. I mean, the ECB, I don't think would be too concerned about that at this stage. I think that would kind of still allow them to kind of continue to move towards this sort of June cut. And the sort of next, or well, not next, but one of the big things that they're still waiting on, though, is that sort of Q1 wage inflation or wage negotiated sort of growth, which that is going to be very important for them. But again, a lot of the timely data suggests it's not going to be nothing that's going to sort of prevent them from cutting still. So ultimately, it's going to be the details going to be important around these numbers, because if we do see that services inflation outside of things that are affected by Easter stay quite sticky, you could start to see a little bit more hawkishness come in into the pricing.
Okay, great. Maybe I'll go through what I'm taking a look for next week. And so I think next week, as we said, we have the Fed, we have the QRA. On the top of that, there is also some important data coming out next week. So first of all, we had the beginning of the week, if I remember correctly, we have the employment cost index for Q1. So we remind our listener that this is the most important and better measure of wage growth in US, which is the preferred measure for the Fed, because it's constructed in a way in which does not suffer for compositional effect. So it's extremely important index. The drawback is that it's quarterly, and so it gets less frequent update. But I think the market is expecting 1% versus 0.9 in the previous quarter, so a little bit of a pickup. But when you look at the trend, has been trending down quite steadily recently. And the hope of the Fed is that, of course, it keeps trending down. Still, it is at a level that is not really consistent with the 2% inflation target. And I would say that if we get an upside surprise on this one, probably the short-term interest rate market could react. Would be the most sensitive part of the rate market to react. So pricing in 24, in 25, 2-year Treasury, just to mention a few. Then we have the April jobs report, including also the JOLTS report and the claim. So basically, it's a set of data in which we have the famous non-farm payroll, then we have the average hourly earnings, which is not a perfect measure of wages, but more timely because we're going to get the April number. Then we have the jobless claim and the jobs opening, quits, and hiring. So in general, the Fed wants all this number to keep coming down for a better rebalance of the labor market. So less opening, probably less, a little bit less, hiring, quits. Hopefully also average hourly earnings in line with consensus, like 0.3, I think is the consensus for the wage growth. With unemployment, stable or if trending higher, not going too high, that would be in line with a soft landing scenario. Again, any surprise on the upside on non-farm payroll, on wages, which I think would be quite important, or a jump higher in jobs opening and so on, would be perceived by the market as a labor market that is less rebalancing, could be a little bit more tight than previously thought. Therefore, again, the short end of the yield curve could react a little bit more in case. Of course, the reaction will be opposite if the data is below consensus. And then we have also ISM, manufacturing and services, and the first quarter unit labor cost. So unit labor cost came down quite significantly since the peak in 2022. Consensus expecting a good pickup, 2% versus 0.4 in the previous quarter. But in general, I would say so far unit labor costs have given some comfort to the Fed that the disinflation will keep going. Personally, even if I take the signal for unit labor cost, as many know, I'm a little bit more hawkish on inflation, and I don't think will be so easy to reach the target without a significant slowdown. But is a point that I already expressed in the past, so I'm not going to repeat too much here. And then we have the ISM. So we will watch with particular interest new orders, price paid, and the main index. And also the employment one. Usually the employment component has been the one that has been, I think, still below 50. The manufacturing one rose quite nicely last month. It was really, quite strong, and it started the sell-off in the rates market, I think, if I remember correctly. And there was also an increase in the price paid, which could signal a little bit less disinflation in the goods sector. So it's something also to watch. Services inflation, vice versa, slowed down a bit, but still above 50. So the picture here is that I think we will look for a confirmation that the economy is slowing down a little bit, which has been confirmed also by the GDP report, but still growth remain above potential. And on non-farm wages and so on, can give more indication also on the inflation side. I think we will get a confirmation that will not that easy to bring inflation back to target for the Fed. So this is what for the next week. Maybe you can Henry, highlight a little bit a few pieces that we wrote here at Macro Hive.
Yeah, absolutely. Yeah, no, that's, I mean, there's been some really good pieces out from the team last couple of weeks. I'll just highlight a couple of the ones that sort of stood out to me at least. So one was definitely Ben and Varesh put out a piece on everything you need to know around JPY intervention. Obviously, currency's been doing a lot lately, and there's a lot of sort of questions around the Ministry of Finance and the Bank of Japan. So that's definitely what I would plug. Liang also wrote a piece on PBOC messaging. So around sort of the kind of basically what they're doing and the kind of mixed messages they've had recently, which has been really sort of useful in terms of insights into exactly how the sort of things are going on in China. I'll just highlight my own piece around taking pill with a pinch of salt, just in terms of his speech and what exactly we're reading into it and what we think the market ultimately will need to read into it, which I sort of already ran through. And then I'd also sort of mention the fact that you did a very good podcast with Bilal this week. So maybe actually you can probably talk a little bit more around the sort of highlights and the most interesting things that kind of came out of that.
Yeah, it was a great podcast. So Bilal went through view on US economy, Fed, highlighting the risk of the Fed actually could not cut rate this year. US rate, also we went through Europe, China, and we had a good discussion on AI, because as many people know, we are investing a lot of time on AI. We are developing our own models around that. We have people, very good quant working on that, alongside Sam that is working on more traditional economic model to forecast economic data, but we are also doing a lot on AI to decode central bank speeches, but not only, also to build other tools to help a client to answering timely question from clients. So there's a lot of stuff going on there. So also with Bilal, we went through that. So actually it's very interesting podcast to listen. So I recommend everyone to take a look. It's available, it's free online. It's
Absolutely. As always, yeah, it's always very useful and interesting those. So yeah, no, thank you very much for joining us today, Antonio. Hope you have a great weekend, and hope all our listeners sort of stay safe and have a great week also.
Thank you. Great weekend also for you. I hope it's sunny. It looks like it's sunny. So if it lasts, it should be a good weekend.
Absolutely.
Okay.
Take care.
Bye, Harry.